Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and as we draw a close to what was a very turbulent year, 2022, and obviously building on the turbulence of previous years, we now take a look into our crystal ball for 2023 with particular reference to the gold and oil markets. A lot of people are very tired. Let's face it, we're all tired from really what has been 3 years, as a friend pointed out to me this morning, of significant ongoing uncertainty for consumers and businesses alike the world over. So I think the dominant theme of 2023, I'm sorry to tell you, is probably going to be, particularly for the gold and oil markets, all about fear again. So I feel that they could both have upside, which is a positive way of looking at the concept of fear. Let's start with oil. Oil can have significant upside even though the US dollar will be strengthening. That's, I think, an almost certainty, given that the US economy will be slowing, Europe, UK, all in recessions, China still not 100% well, and therefore still significant safe haven investment flows towards the US dollar, but also US corporations continuing to bring money home to the United States rather than have it allocated overseas. So a withdrawing of capital from the world by US firms combined with safe haven buying of the US dollar, plus, of course, the ever higher yield return that one gets for holding US dollars. So the US dollar will be strong. And we need to get that out of the way first because we're looking for what we think oil and gold will do. Now, that immediately begs the question, of course, well, maybe I should buy, if I'm going to be bullish because of fear, maybe I should buy oil and gold and sell Australian dollars. So buying Australian dollar oil, if you like, and buying Australian dollar gold. And I think that's an interesting strategy to consider. And that would tend to reflect the major trends of the moment. But of course, one of the other major characteristics of 2023 will be volatility and turbulence continuing. Now, it's not volatility in the usual sense that we're seeing in markets. It's very large counter swings, sometimes as much as 80%, but often around 65, 70, 75%. So not Fibonacci corrections, more like second wave reversals almost to the beginning again, but time and time again for the technical analysts out there. So that makes it very difficult to trade with stop losses, but stop losses we must keep in our trading. They will cost us, but think of that as the price of insurance to avoid a wipeout scenario, which is always possible in financial markets and we should always be guarding against. The fear factor I'm speaking of is really about supply of energy. So we all know there's been general supply chain disruption during the COVID years, and then we've had the shock of the Ukrainian war, Russian-Ukrainian war early this year. We did forecast that. You might remember I wrote an essay, 5 Reasons Why Russia Will Invade, and they most certainly did. At this point in time, Russia is building up toward an even larger number of troops than in the first wave of the invasion, again happening over the December to February period. And a lot of military strategists have been talking about this, and it's something to have in the back of your mind regarding your entire investment portfolio as we move into 2023, that there could actually be surprises out of the Ukraine conflict, whereas a lot of people, most investors had decided that all of the worst of the war is priced into markets. It's most certainly not priced into the lives of the people of Ukraine and Russian soldiers as well. But it is priced into markets. Well, that's what the market has been thinking. I would again suggest extreme caution over that point of view. I actually do believe a further big push by Russia is on the way. And also, I'm not sure Russia is losing the war, as many people are tending to believe. So it's going to be a very dangerous and tricky year ahead for Ukraine and indeed the world. The war is not over. It could actually reach a new level of activity that would surprise and shock markets again. In any case, we know that someone has blown up the gas pipelines from Russia to Europe. I know a lot of commentators like to say Russia's stopped supply of gas to Europe. Well, no, actually someone else blew up the pipelines. But of course it was an issue, it was a strategic issue in play at times. And, all parties could well be at fault there. So I'm not attributing blame, I'm just saying what happened. And it was a third party outside the zone of the immediate conflict that did in fact blow up those pipelines. That has led to an enormous import of energy by Europe from the United States, which means happy days rub their hands together for the energy supply companies of the United States, particularly the LNG side of things, natural gas. And in fact, they have been, preparing and sending, because it's a very complicated task to actually prepare natural gas for shipment, to liquefy it, requires a lot of technology, and there are not a lot of plants that can do that. So the United States has actually been doing it about as quickly as it is possible to do physically, with the technology and the plants that they have for doing that, placing it aboard ships, tankers, and moving it to Europe. Yet, even if the US was operating at full capacity, it could only replace about 20% of what was the previous Russian supply of natural gas to Europe. This is why many European nations, such as Germany, France, and all of them really, are looking at price caps. They're looking at rolling brownouts, if you like, restrictions on air conditioning in factories and office buildings, and asking the consumer to cut back as well. So there is an ongoing energy supply crisis in Europe, and we have yet to see winter really take hold. So far, Europe has been lucky with a relatively mild winter so far, but that may not last. Even a moderate winter going into these colder months now will tend to highlight just how stark the situation in terms of heating and other energy supplies across all of Europe and as well the United Kingdom. So it gets worse before it gets better in summer, I guess. This could be a particularly dark, in fact, literally dark perhaps for some people, winter in Europe. This can only boost energy prices again. Now, we've seen energy prices come back a long way. And in fact, in the US, they've tumbled quite significantly, particularly at the gasoline pump. However, natural gas prices across Europe and in the United States will tend to rise again. I think a lot of the price depreciation we've seen is a lot of these energy companies realizing that they can't just completely wildly profiteer from the situation, so they're making more of an effort to keep their profit margins down again after the windfall profits of 2022. So that does help keep prices lower. But my point is this, the fear I'm really speaking of is the fear of major governments that they could have an energy shortage outside of Europe. So the shortage of energy generally around the world could lead to, and it would be, I think, responsible, but adversely responsible activity for national governments to again build their oil and energy reserves so as to keep their own populations secure from that perspective. Now, the United States announced at the end of last week that it would indeed be seeking to rebuild what it calls its emergency oil reserves. Now, these reserves have been tapped into and they need to be replenished. That alone will support the oil price. Furthermore, we've seen that Saudi Arabia will no longer just do whatever the US requires of it and is steering a much more independent path, and it will in fact reduce supply to keep prices high. So those two factors alone are rather supportive of the oil price in 2023. But here I think is where it gets really interesting, is that when the United States begins to get the idea, as I believe it will in coming months, that perhaps it should have even larger energy reserves than it previously had, perhaps to the tune of 3%, 5%. That is massive. Now, if other countries around the world see the United States moving in that direction, and for all we know, that's exactly what the United States is already doing, but they're not going to come out and tell everyone. They're just going to say, oh, we're just getting our energy reserves back up to what they used to be, as they are seen to be buying extra energy supplies in the marketplace. So it's a form of camouflage as they actually begin to do what I've been warning of for several months now. The start, if you like, of an energy reserves war globally, even between friends and allies. This, combined with a willingness of OPEC to reduce supply to keep prices supported and to be less inclined to increase supply to keep prices down, suggests that a higher oil price in 2023 is a very strong likelihood. As I said, though, the US dollar will be moving significantly higher. So it may not be that US dollar oil or US dollar oil prices may move higher, but the real stress will be in other currencies against the price of oil. So Australian dollar oil, in Australian dollar terms, oil could go through the roof. In euro terms, oil could go through the roof. And this will make it harder again for virtually everyone on the planet to get around for work, take the children to school, do the shopping, go on holidays, you name it. Any form of travel or shipment or movement is all going to get expensive again. This again could lead to a bit of an uptick in US inflation, global inflation, which will again entrench the rather harsh interest rate hiking that is going on among central banks around the world, particularly the Western central banks, which means we're looking again at another kind of energy shock economic slowdown in 2023. And this could be particularly damaging to overall sentiment and consumer and business confidence everywhere on the planet, particularly in the major Western economies, which at some point where the US dollar is just getting higher and higher, and that of itself is doing further and further damage to the US economy as the central bank, the Fed, hikes interest rates extremely aggressively, the most aggressive in history, and consumers, businesses deal with still high food prices and again ratcheting up energy prices. It says the US economy has a hard economic landing, which means that could be the same for Europe and the UK. China is another story. It will maintain, I think, what have been in recent years more normal Western levels of GDP growth, but those Western economies will actually be dipping into negative quite a lot for over the next 1 to 2 years, whereas China will stay positive most of the time, but really in the 2 to 5% range and nothing like the boom conditions of the past. So I'm not really expecting a China boom to drive the oil price up, but more people wanting to build their energy reserves again, the possibility of a flaring up of the Ukraine conflict, and for gold, all of this uncertainty amassing to generate what could occur in the second half of the 2023 should there be enough economic downside to break the back of many a consumer's confidence level. And remember, US consumers are already thoroughly depressed, the lowest confidence levels in history. If they get driven still lower, people may begin to panic away from the US dollar and toward gold. But in any case, gold will be supported by safe haven uncertainty buying very early in the new year. So gold price could be moving higher, and again, a little bit of a question mark against a booming bubble like US dollar. But for other currencies around the world, I would think that gold, based on general economic fear, could move higher in 23, and oil could move higher in 23 on nations beginning to compete to build their energy reserves, that too out of fear. So this may sound a little bit negative, but it's actually very positive, because all of this creates tremendous opportunity for the individual trader and investor against the rather larger organizations, which we know most of which got 2022 entirely wrong and have still yet to grasp fully what is going on in this modern economic melting box that we currently have, probably the most challenging matrix in the history of the world since the end of World War II. So very difficult year ahead, which means it's full of opportunity for the savvy trader and investor, and I wish you that for the new year of 23. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.